Hey, hey. How is everyone? Thanks for being here. Thanks for the invitation. Thanks also to the speakers. Yeah, to kick things off and to begin with, I would like for the ones that don't know the speakers, to introduce very quickly yourself, what you do, and how are you related to the panel, right?
Hi, everybody. My name is Zhixie, like Pixie, but with a Z. I am the Senior Product and BD Strategist at Bob. I'm also one of the founding members. Our team, for people who don't know Bob, we are a hybrid chain, which means that we are a fully EVM rollup on Ethereum built on OP Stack. But we also get finality on Bitcoin. And the mission for our chain and our team has always been scaling Bitcoin, making Bitcoin usable in DeFi and scalable in DeFi. I'm very excited to have this panel with our amazing guests.
Hey everyone, I'm Steven. I'm co-founder and CEO of Offchain Labs. We do a few things. Probably first and foremost, we build Arbitrum, the layer 2 scaling solution, which is both the top layer 2 on Ethereum by value and other metrics, but also we build the Arbitrum stack, which is you build your own blockchain stack, which is adopted by over 100 companies, including the likes of Robinhood. We also build Prism, which is the leading consensus client for Ethereum itself. And recently we acquired a company called ZeroDev, in which we entered the smart account space. So basically building on 3 levels of the stack, layer 1, layer 2, and the application layer.
And I'm David Walsh. I'm the head of enterprise at the Ethereum Foundation. I think most people here probably know what the Ethereum Foundation is, but maybe you're not overly familiar with the enterprise team. So I think you can look at the Ethereum Foundation as split into 3 clusters, where there's protocol that looks after research and development. There's a privacy team, which obviously focuses on privacy, and then there's ecosystem development, where I sit. In June, there was a restructuring of the EcoDev cluster, and we're now a lot more focused in terms of supporting different participants within the ecosystem. So 14 teams of 3 to 4 people. We have an app team, a founder success team, academic team, policy team, and then there's an enterprise or institutional team. I'm not going to bore you with the other 10. But yeah, we're out there supporting a lot more in the space and helping educate around mainnet, but also a lot of our L2 partners within the ecosystem.
Awesome. So first topic I would like to talk about and discuss, it's a bit agnostic, but it's capital. We are seeing a trend that values moving on chain and real world assets moving on chain. So where is all this capital going? To custodians, to L2s, staking, and what are the risks associated with that? Who controls all the value going on chain, and some of the risk and your opinions on that?
I can start maybe. I guess originally it was probably a lot of high net worth individuals, whales, whatever you want to call them, Bitcoin miners. I think over the last couple of years, the ecosystem is definitely starting to mature, where there's different DAT companies that actually control around 5% of the supply of Ethereum. There's more and more financial institutions coming to market. So a lot of the likes of BlackRock or Fidelity, some banks, all getting involved in terms of custody solutions. Mm-hmm. Then you have obviously centralized exchanges or custodians, which still control a lot of the way the different products go on chain, whether it's a Coinbase with their L2 or their staking operations, whether it's a BitGo or an Anchorage. I think it's good to see the ecosystem is maturing in a number of different ways, though. So it's kind of coming into it's coming into an interesting period at the moment.
Sure. Yeah, I'm just going to follow up from there because David mentioned, how whales and whales want to move their assets on chain, and a lot of time they have to rely on custodians. And I would like to chip in from the Bitcoin perspective because what our team have always been building is kind of like a gateway for Bitcoin liquidity to seamlessly move into the Ethereum world, because we see a lot of DeFi activities and opportunities happening on Ethereum DeFi, which is not accessible for Bitcoin hodlers, because the on-chain yield on Bitcoin, there's only one form on Bitcoin, which is mining, and it's quite inaccessible for normal people due to how expensive it is to set up the hardware and how complicated it is from technology-wise. So for, I guess, enterprise, institution, whales, or even retail users to, like meet this demand and actually earn something on-chain in a not through like centralized manner, the way to do it would be going through bridging. And for Bitcoin, it's tricky because there's no smart contract capability on Bitcoin, so a lot of these more advanced, more trustless way of bridging Bitcoin doesn't exist. So naturally, like we talk to a lot of liquidity providers who want to earn more yield on their Bitcoin, and instead of going through all of these experimental like trustless or trust minimized route, the way to do it is actually going to people who they can actually trust, and like Bigo, who David earlier mentioned, have wider adoption than some of these, more decentralized way of wrapping Bitcoin, because when they put their Bitcoin there, they actually, instead of, going something that's new and experimental, the traditional Bitcoin whales will rather put their Bitcoin in somewhere where they know the person, they know the custodian. So it's actually quite controversial where when you look at Bitcoin, the most decentralized and oldest cryptocurrency, the hodlers actually would prefer trusted solution. And this will actually lead to another topic that I would like to expand on later, which is BitVM, which we believe to be one way of bridging Bitcoin in the most trust minimized way, and potentially would be preferred also by institutions.
One of the things that inspired me to build a scaling solution for Ethereum, like originally actually, so many people think, oh, you scale, so you need to make more capacity for the same, but actually, that's one side of the coin, which is you increase bandwidth, increase throughput, increase capacity, but the other side is actually lowering cost. And when you lower cost as part of scaling, you don't only increase more capacity for the same, but you actually fundamentally change the makeup of the system, and you lower the barrier for who can participate. And what I mean by that is, if you look at Ethereum, in its highest price point, at the time when Arbitrum was coming live back in like 2021, it was inaccessible for a retail user. If you wanted to trade $100 even, certainly less, but even $100, it didn't make sense because your trade was just, it was quickly eroded by the fees that you'd have to pay to do that. And certainly if you wanted to trade $50 or $10, and if you look at users throughout the world, we weren't really serving users in underbanked or underprivileged markets because they simply could not pay the fees to transact in these chains. So when the question is who owns the capital, it's still the case on Arbitrum actually that the majority of the capital is probably held by whales and larger users, but that's okay. There's also a large number of accounts that hold a little bit of capital, and that to me is actually changing that makeup is probably the most important part of scaling, because to be honest, I live in the US and the banking system works, right? I think we're building a better system that has more efficiency, better trust, but like we have a system that works today. But in many parts of the world, they actually don't have a system that works, and that's where our technology can have the most impact. But if the fees don't meet the users where they are and it's not usable, we can't do that. So that actually to me is, even if it's not going to be the majority of the ownership of the capital on chain, the fact that we've now enabled people in the developing world to have USD balances and pay for their groceries in crypto is one of the biggest unlocks that we've had in terms of who owns the capital on chain and ultimately who's able to participate in the system.
Thanks. So the following in the institutions topic, some questions that are all related. When talking about institutions, it is a wide spectrum. There is public sector, governments, private sector, banks, and more. How are these institutions getting exposure to crypto? which vehicles are they using? Is it yield-bearing stablecoins? Are they just buying BTC, tokenized funds? Which vehicles are they using? And also, are they using service provider like Vico, and you mentioned Fireblocks and centralizing there, or are they are you seeing a trend, institutions starting to hire and build in-house native crypto teams, or just going to service providers?
I think a lot of companies have significant digital asset teams these days. I think previously maybe a couple of people in an innovation lab somewhere looking at random proof of concepts, but I think today very much institutions are in build mode and not just trialing products, like actually building their business around blockchain services. Like if you look at Robinhood on Arbitrum, like that's a real product gone to market and that's live today. And I think every single day that you look at the news, there's new financial institutions like launching products or making announcements of different products, I suppose. So if you look at the Hong Kong market, there's a few different projects that are in a sandbox right now for the Hong Kong dollar. I think Standard Chartered are involved. JD, which is like the Chinese Amazon, are very much involved there. There was an announcement around Swift Ledger at Sybos, which is like 50 banks participating on an Ethereum-based solution there as well. So I think we're very much in build mode. I think another one was like the Digital Euro Consortium with 9 or 10 banks coming together to build a Euro stablecoin. So I think, yeah, we've gone past the proof of concept trial phase for sure, and we're very much in adoptions, so like scale and timing right now. And the likes of Arbitrum are doing an amazing job of, bringing that to the masses essentially.
Yeah, I'd say I totally agree with all that. I'd say we've seen like a pretty interesting shift over the past few years. It's been quite a number of years where there have been institutions that have been taking part in crypto and have teams. But I would say until maybe the last 12 to 18 months, these were generally isolated experiments. It's like, I'm a bank, and then we do that weird thing over there with crypto, and some team has some funding to do that. The beauty of like Robinhood and Arbitrum, and this is a theme we're seeing really across the ecosystem and across the institutional adoption today, it's not some side quest or some side product. It's actually the core Robinhood app in the EU is run on Arbitrum. And that's like the most exciting thing that we're seeing today. The fact that institutions have been playing around on their private blockchains for at least 5-6 years now, but now they're actually understanding the public blockchains. Ethereum is the way to go. That's a big unlock that we've seen. And number two, they're actually doing this in their core products and not something separate. And I think we, as an ecosystem, sometimes hurt ourselves. And there's a point I've made many times, but I feel like it's an important one. We sometimes hurt ourselves with our adjectives in the sense that we don't realize that we're not a side quest, right? I've met many people, and I say, what do you do? And they say, I work in DeFi. And I've never met someone that told me they work in centralized finance, right? They just call that finance. So I think, well, when RWAs just become A's, and when DeFi just becomes Phi, and we understand that we're not doing this weird, cringe side experiment that's parallel. Actually, crypto is mainstream finance. And by the way, we see this go both ways. We see real-world assets like tokenized money market funds, private equities like Robinhood is doing, being packaged up onto the blockchain. And we see blockchain assets being packaged up for institutional investors via DATs or ETFs. And if you zoom out, it's like, okay, this is just part of the financial system. And that's, I think, important for us to recognize, because institutions are now recognizing that, and we certainly need to do that as well.
I feel so pumped hearing that. Like,
thank you.
Yeah, I love that. Like, exactly. Well, there are three things that I am pumped about by what he said. First is everyone is realizing Ethereum is the way to go. And I want to echo that because there has been so many experiments. There are so many ecosystems there, and Ethereum is the one that lasts. And Ethereum is one that's battle tested. So when we decided, okay, we're going to build a Bitcoin layer 2, we're like, we want it to be institutional graded and institutional friendly. And what kind of technology would people be willing to use? And that's got to be the one that has been battle tested. And that will be the same reason why Robinhood want to launch on Arbitrum. And the other thing is, like what he mentioned about a real world asset become just, asset on chain, and DeFi become just the nature of finance. And echoing back to the question, which is, like how does infrastructure, how do institutions work with decentralized finance technology? We're actually seeing that it's not just institution adopting service provider in order to use DeFi, but rather institutions actually have incentives to use blockchain technology in order to facilitate what they're already doing. One example will be, like everybody is talking about cross-border payment using blockchain, and we're seeing that, for example, for like Grab, I think in Singapore they use, I think Avalanche or one of the chains for transacting between Chinese yuan and Singaporean dollar, and you don't need to market, you don't need to put this on the news, but rather this is simply faster and cheaper than going through banks. And same thing with tokenizing financial, like stocks, bond, or real world asset, where a lot of unbanked people, the whole, I guess, mission for us people building on DeFi is to make sure that financial means are accessible for most people, and people have easier access through DeFi, through like these tokenized assets, rather than going through directly the traditional finance. And this also provide institution a bigger audience. This is why we see like institutions starting to grow on chain. And also there are different types of institutions. When we talk about institution, there are traditional finance institution who is not on chain, but there is also crypto native institutions like exchanges. And we see that crypto native exchanges or institutions moving towards on chain, and maybe TradFi and real world institutions moving towards at least having exposure to crypto. So there's different levels of progressions here.
Thanks. And when talking about products and tokenized funds, and as Steven mentioned, there are many on-chain credit, tokenized funds. There are many products already being used. What are you most excited about, or what is still in proof of concept mode or experimental that you would like to see in the future? Maybe some more degen stuff, or what are you most excited about?
Sure. I would say two things. Number one is, I guess what gets me more excited is products that go like further along the risk curve, and we're seeing this happen. We started off with like the most conservative or boring sort of funds coming on chain, money market funds, U.S. Treasuries, and we're seeing now a progression through now to equities, to actually private equities on chain as well. I think that's a very interesting progression. And the second thing is, and this will happen in time, and a lot of this comes from regulatory approval, because the issuers are, sometimes some of the largest financial institutions in the world. I spent a lot of time with Franklin Templeton, and they tell me the work that they're doing at the SEC, and just to see a company of that stature and that, that much history in the space actually engaging with their regulators so much to increase the pathways of what they do on the blockchain. It takes time, but it will happen. But what I'm excited about is not actually the individual standalone tokenized assets on chain. There are nice things about that. Okay, you have cheaper bookkeeping, you have broader access, but actually the integration of those products into everything else on chain, right? So the integration of these funds as collateral for stablecoins into DeFi positions, that I think is going to be the big unlock. And that's the convergence, everything I was just saying before, when it's not like, okay, you have this isolated thing on chain, but it's actually part of the entire on-chain community.
Yeah, I guess what I'm most excited about is how blockchain infrastructure and the on-chain economy becoming something very fundamental and integrated into the institutions. It was something that I saw very exciting last week when I was in New York for Chainlink SmartCon, is I learned about, how we have like layer 0, CCIP, all of these like messaging standards for fixing the problem of fragmentation of liquidity on chain and the different technologies. But they're also, building now messaging standards between fiat money and on-chain assets to fix the, issues with fragmentation when it comes to technologies that's being used to bridge Web 2 and Web 3 infrastructures. And I can see this not only working between assets, but I can imagine a world in the future where maybe our identities are on-chain, maybe our, maybe more than that, maybe our storage of everything. There's so many things that can go on-chain and will be more efficient on-chain, and we need interoperability not just between chains or between assets, but also between the real world and what we're using online. And I'm just very excited to see that happening.
I'm just really excited to see how the space evolves and grows. Like, I think we're still in very much early innings of tokenizing on-chain. We were in Hong Kong maybe 2 weeks ago. All of the weeks are blending into one. But we met with Standard Chartered, and Jeff Kendrick put out a prediction that assets, or RWAs, however you want to call them, will grow from 35 billion to 2 trillion by 2028. And that's a 58x. And he was saying that the majority of that will happen on Ethereum or Ethereum-based solutions. So just seeing that mature and evolve, I'm extremely excited about. I think AI, decentralized identity, all of those areas definitely need to mature too. And I think one thing that maybe if anyone here is building, or if anyone knows of a product or a solution for secondary market liquidity on private credit products, I would also be pretty interested to hear or learn about that, because yeah, we see a lot of different products right now going on chain, but there's not much secondary market liquidity actually happening. So if anyone's familiar or knows of those products, let me know.
Okay. So when talking about connecting on-chain, off-chain worlds and that intersection, what key pieces of infrastructure is still missing, or you would like to see in terms of institutional adoption more natively? I'm talking about maybe governance tax for treasuries, maybe programmable policies, or to be more compliant. I don't know if you are working with partners, service providers, working off-chain, or maybe you see or you're excited about some teams working in this intersection.
From my side, I think privacy needs to evolve massively. I think we're so we onboarded in June, and every single conversation we had was, well, what privacy solutions are on Ethereum? It's not very private. And that's not true. There's actually a lot of privacy solutions that are out there and that are evolving and maturing. I think that's an area that I'm very excited about, and what we actually did was launch a team at the Ethereum Foundation called Institutional Privacy Task Force, which is a guy running it he's ex-Goldman Sachs, and he's a privacy researcher. And we have around 5 or 6 other privacy developers working with large institutions. So when they say, we want privacy, like, what does it actually mean? You want shielded transactions, you want a specific environment, and we're helping to spec out the exact solution and then help build proof of concepts and then bring that to different teams within the ecosystem. So I think for sure the privacy space needs to evolve and mature to see these numbers that all of these firms are predicting.
Yeah, I'd agree actually on privacy being a very important one, and actually it's one that there are people. The graveyard is full actually of teams that have built privacy ahead of their time, and the truth is, like, this is the way it always works. It happened with scaling too. People like ignore it for years, and then they want it, and they're like, "Where is it?" And so, well, we tried, and you didn't want it. And that's actually what's happened with privacy. It really wasn't product market fit until we really have this institutional play now, and now there's extreme demand for it. But actually, it's okay because the notion of privacy, like you were saying, it's actually evolved over time, right? So if you go back to 2018 when people were talking about privacy, they were actually talking about usually consortium chains, which is a very different notion of privacy. It's like a few banks are running a chain and they know everything, but nobody else knows something. If you go back a little further to when Zcash first was launched, the notion of privacy was like these shielded transactions where absolutely nobody knows anything. Today, institutional privacy is a different form of privacy, which basically matches what we do in the real world, which is my bank knows everything about me. They know where I live. They know how much money I have. They know where I spend that money. Like, they could totally ruin me. No one else, though, my neighbor, who also uses the same bank, doesn't and shouldn't know anything about my transactions. And this is basically the notion of privacy that we have today, and also one that actually fits with lots of regulatory frameworks where the institutions need to keep certain information, but they want to preserve that privacy. I don't know if you use Venmo, but I feel like one of the weirdest features ever is that you can have this feed of who you pay money. When I signed up for Venmo, I turned that off right away, and that's the status of the blockchain today, and that's something that most users will not accept. And just to pop the stack a little further, if we zoom out, it's not just privacy. Actually, it's just and what we believe in is customizability. The idea that there's not one solution for everyone, but we have to meet institutions where they are. Because what BlackRock wants actually is going to look very different than what Robinhood wants. And actually, what Robinhood wants is going to probably be very different than the leading fintech here in Argentina. Because everyone has a different set of conditions that lead to those. And how do we build tech that can bend to them and be customized to exactly what you need, and that's what we are doing at Arbitrum. We have the Arbitrum Orbit stack, which is used by 100 plus teams today, and in probably not 100 different varieties, but probably like 65 different varieties. The idea that you can customize this stack really however you want to meet your business objectives, and that's going to be important for institutions, because if you think that we're going to be able to go to institutions and say, hey, the crypto bros are going to tell you what you need, like, that's not going to happen. But if it's like, hey, tell us what you need and we'll give you the technology, the best technology, the most secure technology, Ethereum level security, Arbitrum expressibility to actually meet your need, that's what's going to allow us to meet every institution where they are.
And what Stephen said about privacy or private chains, like I think in the last couple of, maybe a year or so, institutions are really getting that. Like a private chain is just a walled garden where you can still see all of the information of the different participants, and network effects and network scale never ever happen on those types of chains. You can see with the regulatory environment changing that more and more of these institutions or enterprises looked at those private chains, saw the failures, and now are moving to permissionless environments.
As you wish. Okay. So, well, with all these big players coming into play and institutions, you know that credible neutrality has always been a core value and ethos in blockchain community, Bitcoin, Ethereum. With all this capital coming into play, how do you imagine the next couple of years? How will it play out? Maybe some misalignment, capture. We are seeing maybe banks hiring talent, more interest coming into play. How you imagine institutions and builders, communities, all collaborating in the next couple of years?
Sure. So if I'm understanding it correctly, your question is about how do you see the future of institutions and builders and just everything?
Yeah, you get some interest, power coming into play. And
so kind of like what I mentioned before, I definitely see crypto native institutions growing more and more on chain because the appetite and the demand for on-chain economy is growing. So purely centralized institutions will be under a huge threat if they don't have any on-chain solutions or on-chain product. And traditional finance institutions would adopt blockchain technology for, Traditional finance institutions would adopt blockchain technology for efficiency. Enterprises would adopt on-chain technologies for, better products and user experience. And when it comes to the builder, definitely I see a possibility of more and more protocols and projects, taking into consideration what institutions and regulators want. So instead of completely working against each other, we will have institutional-friendly products on chain, and we will have like retail and normie-friendly products that are maybe wrapped into the normie-friendly UX, but having the engines running on the blockchain.
On the point of, I guess, credible neutrality, I think this is really where Ethereum wins. And the idea is that it's not the case that fairness or neutrality doesn't mean anyone who tries to build a product on chain is going to win. But it means that there should be a fair and neutral environment that that the cards aren't stacked against you. You're not competing against the house, right? If Ethereum started launching DEXs and assets, that would be a big problem. And it sounds funny, but actually there are lots of chains where those operating the chains do exactly these things. Kind of like Amazon, right? You can sell something on Amazon, And then if you get too successful, though, unfortunately, the platform is going to start competing against you and crush you. And that's, I think, the thing that we don't need, that we actually need to make sure we have credible neutrality. I like to say in this way, Arbitrum is the Ethereum of L2s, because this is the same principle that we operate with. Even from the very earliest days of Arbitrum, we did what we called a fair launch, which was basically we opened up Arbitrum in May of 2021 to developers, and then we waited 3 months and gave any developer access, and we waited 3 months, and we opened up to all users on the same day at the end of August. And the idea was that some apps wanted priority access and said, "Hey, let us launch first, and we're ready. Let's go." And the answer was no. Everyone should be on the same footing. And on the same day that Uniswap went live on Arbitrum, SushiSwap went live, and a little exchange you probably never heard of by DXDAO called Swapper went live. And if you're looking at it, it was probably pretty clear that Uniswap was going to win because they executed well in layer 1 and they should execute well in layer 2. But it shouldn't come, and it didn't come from us saying, okay, since you're winning here, we're going to roll out the red carpet. You're going to win there. No, you're going to get the same access as everyone else, and you're really good at what you do, so you'll probably succeed there. So that's, I think, what we believe with credible neutrality is important, and ultimately creates an environment which is fair, and by the way, much better than the real world. Because if you want to get like an investment banking job in the quote-unquote real world, you'll have to have a particular pedigree, probably a degree from a particular university. It's extremely hard to actually enter, particularly if you want to build a financial product. Nearly impossible to actually integrate into the financial landscape today. You really have to have the right set of backers and just the right fate in order to do that. But in the blockchain space, you can have a good idea that you have 2 people working in their garage or in their house if they decide to, coding that idea and just basically enable to launch into the world financial system. That's the importance of credible neutrality, and that's why on the Arbitrum side, you don't see us launching competing products with anyone else. We basically like to build the best infrastructure and the best environment for everyone else to thrive. Some will lose, some will win, but we're not going to make that decision.
Yeah, I think credible neutrality is definitely Ethereum's biggest selling point. There's no central coordinator, there's no pause button, there's no CEO. It's very similar to the internet in that way. And it's resilient to geopolitical risk. It's resilient. It's the most resilient network, right? It's been live for 10 years, no downtime, and I think just generally that's what institutions really value when they look at deploying millions, billions, or trillions of dollars on chain. Essentially, where there's no counterparty risk is where they want to deploy, and also around, I guess, in terms of token supply, having an idea around where tokens are allocated and where tokens are held and who can actually control the network is, definitely a massive consideration for a lot of the larger players.
Yeah, this question came from the recent Dangrad hiring. I don't know if you remember and saw that. But maybe we'll start seeing more JP Morgan hiring crypto native and crypto projects or blockchain projects hiring institutional players, and that was the case. And how will it play out? I was discussing with a fintech chamber guy, but I think that's it. I don't know if anyone else wants to comment anything, but thank you. Or any questions for the guest and the speakers? Anyone? It's now or never. Okay. Thank you very much.
Thank you.
Thank you.